All right, listen. Something major just happened in silver. In the last 24 hours, silver jumped about 2.8%, and it's sitting right around 82.99 an ounce right now. And if you weren't watching closely, you could miss how aggressive that move actually is, because silver doesn't casually do that unless somebody somewhere is getting forced to react. Let me put real dollars on it. If you hold 1,000 ounces, maybe through physical, maybe through a trust, maybe through a mix, that's roughly a $2,300 swing in a day. Not a month, not a quarter, a day. And gold is up too, but it's calmer, about 0.6%, around 50.056 an ounce. That gap matters, because when silver starts leading gold like this, it tells you the market is shifting from quiet hedging into something more unstable. But here's the part most people are going to get wrong. A move like this can be the start of a larger breakout, or it can be the exact kind of spike that shows up right before the market snaps back and punishes late buyers. So in this video, I'm going to walk you through the three things that are colliding right now, why silver at 82.99 is a level you need to respect, and what I'm watching next, so you don't get emotionally pulled into the wrong decision at the worst possible moment. This isn't just normal market behavior. Here are the three factors that converge today. First, the macro narrative just got messy, and metals are reacting in real time. Over the past day, the market has been whipping between rate cuts are coming and not so fast. When economic data comes in strong, it can dampen rate cut expectations, meaning yields and the dollar can firm up, and that normally pressures precious metals. When data comes in softer, it does the opposite, and metals catch a bid. And the key point is this: gold can absorb that back and forth because it's treated like a monetary asset first. Silver can't. Silver is part money, part industrial metal, and when the macro story turns into a tug of war, silver tends to get traded like a leveraged version of whatever emotion is dominating the tape. That's why you can see gold up modestly while silver is sprinting. Second, silver is still in that high volatility zone where stop runs are easy. Let's keep this simple. In a high volatility regime, prices don't move smoothly. They lurch, they spike, they rip higher, then slam lower. And the reason is not magic, it's positioning. When a market has too many traders leaning one direction, the moment price moves against them, they're forced to cover. That buying isn't belief, it's survival. Then, after the forced buying is done, the market often pauses, and either continues higher because real demand is there, or collapses because the move was mostly mechanical. So today's jump to roughly $83 isn't just a number, it's a stress test. Third, the underlying silver story is still supply tight, and investment demand hasn't disappeared. Even after sell-offs, even after shakeouts, the structural story doesn't magically reset overnight. Silver has been dealing with persistent deficit narratives, and the investment side has a habit of coming back fast the moment people feel uncertainty creeping in again. And when you combine structural tightness with a market that's already jumpy, you get what we got today. A sharp move that feels unbelievable if you're not living inside the metals market every day. Now let me connect those 3 points. Macro uncertainty, a volatility regime, and a market that doesn't take much to squeeze. That is exactly the recipe for the kind of move that headlines will call shocking, right before the next move makes people regret being late. So what matters now is not celebrating the green candle. What matters now is understanding whether this is the beginning of something bigger or the kind of squeeze that sets up a very painful reversal. Now, I analyzed the price action this morning, and here's what jumped out at me. When silver is up roughly 2.8% in a day and trading around 82.99, the first thing I'm asking is, did we move because of real buyers stepping in, or because weak positioning got forced out? Because those two scenarios look identical in the moment. They feel the same. They both print higher prices, but they lead to totally different next steps. Here's how I think about it in plain English. If this move is real demand, the market tends to hold its gains. You'll see silver stop dropping on pullbacks. You'll see dips bought quickly. You'll see the price respect the breakout area. And even if it chops around, it won't completely give the move back. If this move is mostly a squeeze, the market often does this nasty thing where it gives you one more push higher, just enough to convince everyone the move is confirmed, and then it rolls over hard. So what levels matter? The level that matters is the round number zone right around 83. Psychologically, it's huge. Traders anchor to it. Retail anchors to it. Institutions watch it because they know everyone else is watching it. And when a market is volatile, those psychological levels become magnets. Here's the simple playbook. If silver can stay around this zone and not give back the move quickly, that's bullish behavior. Not because it guarantees anything, but because it suggests buyers are defending the area. If silver loses this zone fast, if it slips and can't reclaim it, then today's surge starts to look like a stop run, and the market could retrace a big chunk of the move just as quickly as it happened. And that brings me to the gold comparison. Gold is up, but it's not exploding. Gold around 50 or 56 tells you there's still a bid for monetary hedging, but not a full-blown panic stampede. When silver is the one acting wild while gold is steady, that's often when people get hurt, because they treat silver like a sleepy metal and forget it can behave like a high-octane risk asset. Now zoom out for a second. What Wall Street analysts aren't discussing is how quickly sentiment flips in metals. One day it's silver is dead, next day it's silver is unstoppable. And the truth is usually in the middle. So what do you do with that? You focus on process. You don't chase, you don't panic. You let the next 1 to 3 sessions show you whether this was real accumulation or a mechanical squeeze. And you watch the relationship between gold and silver. If silver keeps outperforming while gold stays firm, that's a sign the move could be building into something larger. If silver fades while gold holds, that's a sign the silver move was more speculative than foundational. Now let's get into the fundamentals, the real supply and demand picture, because this is where people either get clarity or they get lost in slogans. Silver is not just money, it is a raw material that gets consumed. Solar, electronics, EV supply chains, defense and aerospace, medical, data centers. So when the economy is humming, silver can rally with industrial demand. But when the economy slows, silver can still rally. If the monetary side of the market turns defensive and investors start seeking hard assets. That's why silver is so tricky. It has 2 engines. Sometimes they run together, sometimes they fight each other, and today's price action is screaming that one of those engines just revved. Now, I'm not going to throw a bunch of statistics at you that you can't verify in your head. I'm going to keep it practical. The practical point is this. When a market has a persistent deficit narrative, it becomes very sensitive to bursts of investment demand, because there isn't a giant cushion of extra metal waiting to absorb a sudden wave of buying. And that's why you can have these violent moves. A small shift in psychology can create a big shift in price. Now, add the macro layer again. If the market starts believing rate cuts are delayed, that can be headwind for metals in the short run. But if the market believes something deeper, like financial instability, geopolitical stress, or a loss of confidence in the purchasing power story, that can overwhelm the rate narrative quickly. That's the real tension. And that's why I keep telling people, don't anchor your entire thesis on one thing like the Fed will cut or the Fed won't cut. Metals move on confidence, on fear, on liquidity, on positioning, on real-world flows. Which brings us to the institutional side. Smart money moved before the crowd noticed. And you can see the broad outline of it in the way central banks have been behaving, especially with gold. When you've got ongoing official sector buying narratives out there, it creates a psychological floor for gold. It doesn't mean gold can't drop, of course it can, but it means dips get treated differently than they would in a market where official demand is absent. Now, how does that tie into silver? Silver is the smaller market. It's thinner. It's more reactive. It doesn't take as much incremental demand to move it. So when gold has a supportive institutional story, silver can become the pressure valve where speculative money expresses the hard asset theme with more volatility. That's why today's silver surge matters even if you're primarily a gold person, because it's telling you the temperature in the room just went up. And when the temperature goes up, markets don't whisper, they shout. Now, I've tracked this pattern through multiple cycles. We've seen this exact pattern before. Back in 2020, when markets were under stress and liquidity was doing bizarre things, you saw metals behave in a way that confused people. Gold would act like a safe haven 1 minute, then get sold the next. Silver would move like it was possessed. Big drops, then explosive rebounds. And here's what matters about that period. The people who got hurt weren't the people who were wrong about metals. The people who got hurt were the people who had the right idea, but the wrong timing, the wrong sizing, and the wrong emotional response. They chased strength at the top of a burst. They panicked on the pullback. They sold into weakness, then watched price rebound without them. That's the metal cycle in a nutshell. Now, I'm not saying we're replaying 2020 exactly. The world is different, rates are different, the financial system is different, but the psychology is identical. A sudden move pulls attention pulls emotion pulls bad decisions, and the market feeds on that. So if you're watching silver at roughly $83 and you feel your pulse going up, that's your signal to slow down, not speed up. The best decisions in metals usually feel boring when you make them. The worst decisions feel urgent, obvious, and I can't miss this. Let that sink in. Now let's make this personal. If you're holding silver, physical, funds, miners, anything tied to it, today's move can make you feel like you just got rescued. But here's the truth. One strong day doesn't resolve the volatility. It just reminds you that volatility is alive. So here's what this means for your portfolio in real dollars. If silver is up about 2.8% and you have $10,000 worth of exposure, that's roughly a $280 swing in a day. If you have $50,000 exposed, that's about $1,400. If you're someone who's built a large position over time, maybe you're thinking in terms of hundreds of ounces or thousands of ounces, your daily P&L can start looking like a car payment or a mortgage payment, and that's where people start making mistakes. Because when daily swings get big, your brain tries to do something. But doing something at the wrong time is how you turn a volatile asset into a personal financial disaster. So what's the smart way to frame the next few days? You treat this like a window, not a get-rich window, not a panic window, a decision window. A window where you watch whether the market respects this level, whether silver holds its gains, and whether gold remains steady above 5,000. Because if silver holds and gold holds, it tells you buyers are defending the hard asset theme. If silver fades hard while gold stays calm, it tells you today was more froth than foundation. And if both fade, it tells you the macro headwind is overpowering the bid. None of that is financial advice. That's just reading the behavior of the market like a professional instead of reacting to it like a headline addict. And I want to say this clearly. I don't know the exact top or the exact bottom. Nobody does. Silver could rip higher from here. Silver could pull back first and scare everyone. Both outcomes are normal in a high volatility regime. What matters is not pretending certainty. What matters is being positioned in a way that you can survive either path without blowing up your plan. Now, look, the question isn't whether volatility continues. The math is clear. The real question is, are you positioned for what comes next? In every previous cycle where confidence got shaken, whether it was 2008, 2011, 2020, hard assets preserved purchasing power far better than paper promises did. Not perfectly, not in a straight line, but historically, that's the role they've played. Right now, silver is around 82.99. Gold is around 50.56. The next week matters because it determines whether today's surge was the start of continuation or a squeeze that gets retraced. This is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations. But the data tells the story. And the story today is simple. Silver is moving like something is changing. Now let's finish with action steps you can take without gambling. First, stop thinking in headlines and start thinking in levels and scenarios. If silver holds near this zone, that's information. If it can't, that's also information. Second, watch the gold-silver relationship. Silver leading can be a signal of acceleration. Silver fading can be a signal the move was mostly speculative. Third, don't let one day rewrite your entire plan. If your plan is solid, one day is just one day. All right, before you go, 3 quick things. 1, drop a comment below and tell me where you're watching from, and give me your prediction. Where do you think silver is headed by the end of this month? 2, if you're not subscribed, hit that button now. I'm putting out unfiltered analysis consistently. And listen, I'm fighting copycat channels stealing this content. If this video provided value, comment data over hype so the algorithm knows you're here for the original. 3, next video drops soon, and I'm covering the one indicator that tends to flash before these metals moves turn into something much bigger. It's flashing again. You won't want to miss it. See you there.